Hello everyone, this is Xavier Crowley, and on behalf of UNSW Economic Society, we welcome you to our Term 3 Week 5 market recap. Finally getting out of lockdown edition, covering the latest macro events in the ANZ region. This week we have the current news for COVID, monetary policy and other regulations, the energy sector, and more. So as a quick COVID update to start, New Zealand Prime Minister Ardern announced that from midnight this past Tuesday, some reduced restrictions, such as increased meeting capacity in houses. Ardern promised a three-step reopening as vaccinations increase, with the next step including retail opening but with timing uncertain. Also last week, we saw some changes to the New South Wales roadmap as Dom Perrottet became the Premier as Gladys stepped down. Most notably, the increased capacity in households from 70% double vaccination rate and no masks at desks in offices from 80%. New South Wales is set to start opening back up this week, having reached 70% vaccinations, and is on track for 80% double vax rate in this coming week as well. Now onto some monetary policy musings. October policy statement repeated conditions for a rate hike are not expected to be met before 2024, quite a while away, and once again noted the economy is expected to recover in Q4 as vaccinations increase and restrictions ease, as we've seen in New South Wales this week. And more interestingly noted that businesses are now planning for an easing of restrictions and confidence is holding up well. While restrictions have had a significant effect on the labour market, RBA's business liaisons and data suggests firms are seeking to hire workers ahead of expected reopening, perhaps for training purposes. Across the ditch, the RBNZ this past week raised the overnight cash rate by 25 bips to 0.5%, as markets expected. Their October policy statement showed further removal of stimulus is expected over time to maintain price stability and maximum sustainable employment. We've heard that one before. It highlighted the risk that capacity bottlenecks become more persistent, feeding through to inflation. While the current lockdown is expected to result in a sharp contraction, restrictions have not materially changed the medium-term outlook for inflation and employment since August. The RBNZ was confident economic activity will recover as restrictions ease. Who wouldn't be? Added to that, raising interest rates is expected to constrain house prices to more sustainable levels, which is a bit of a joke in New Zealand, but we'll find out. On the macroprudential side, APRA announced that it is increasing the minimum interest rate buffer to 3% above loan product rate versus 2.5% previously. This basically constricts lending for home loans. This comes after regulators last week flagged tougher macroprudential settings in response to housing credit growth outpacing income growth, which we've seen for the past who knows how long. Importantly, APRA opted against imposing debt-to-income limits at this stage, arguing they would be operationally complex and may lead to higher interest rates for some borrowers. APRA also chose not to use an interest rate floor, as that measure would be more restrictive on owner-occupiers than investors. More on housing, the AFR noted that the proportion of participants in the first home loan deposit scheme that were 18 to 24-year-olds rose to 23% in the year to June 2021, from 17% in the first 6 months of the scheme. The increase coincided with the surge in property values, which made putting together a deposit harder for young people. The article also noted that these borrowers were most likely to be affected by APRA's recent increase in the minimum interest rate buffer. That's us, guys. Feels bad. On energy, a hot topic this past week, the chair of New Hope Group, a Queensland coal mining company, Robert Milner, said he expects thermal coal prices will remain elevated over the medium term amid strong Asian demand. Newcastle coal has soared to record highs after a fourfold increase over the past year. Milner concurred with the view that China's ban on Australian coal had actually contributed to the record rally, with other major suppliers, Russia and Indonesia, failing to meet Chinese demand. Cargo analysts said China had actually been started unloading a small number of Australian coal cargoes waiting outside Chinese ports. While China has an unofficial import ban on Australia, analysts noted about 450,000 tonnes have been discharged, although this was later disputed in the week by the Financial Review. Shipping firm Flex LNG noted one LNG cargo sold on the spot market is now worth almost double the price of a week ago. Sheesh. While this is a boon for the major LNG producers, it is also stoking concerns for domestic manufacturers given East Coast gas prices are linked to these international LNG prices. Upward pressure on LNG prices is also seen as a byproduct of the record rally in coal prices, which is forcing China to compete with Asian buyers for LNG. And this week on the data dump, we have an August trade balance at $15 billion surplus versus a consensus $10 billion surplus. and 12 billion surplus in July. So really pushing up the trade there, made up of a 4% rise in exports versus only a 1% rise in imports. And that's all, folks. Have a great week.